Institute of Business Management, Bangalore. He was the chairman of Mangalore branch of Institute of Chartered Accountants of India for the year 2009-2010. A warm welcome to you, sir. And now I would request sir to take over the session. Welcome, sir.
Thank you very much, Kevin.
You're
for the
welcome,
introduction. Sir. Good morning. Good morning to all students and faculty members. Now, this is a very interesting topic, financial statement analysis and regulatory compliances of bank. And of late, this particular topic has got even more importance because of the kind of frauds and the amount that gets involved in the fraud increasing. We have crores and billions of rupees being reported as frauds, and as such this particular topic gets all the more importance, and particularly banks who are the custodians of people's money in the form of deposits. When they report large quantity of and large amount of frauds, it becomes all the more important that whoever is analyzing the financial statement has to do it threadbare, so as to see to it that if at all a decision is to be taken either for investing in this particular bank or to decide whether you want to keep your money in the bank, you take a proper, well-informed decision and a judgment. Okay. So before I start with the presentation, a small quote from article where financial reporting still falls short, which was published in the Harvard Business Review. It read as, in a perfect world, investors, board members, and executives will have full confidence in the company's financial statement. Unfortunately, it's not what happens in the real world for several reasons. The emphasis is on the word confidence. Okay, as the quote says, it says, in a perfect world, everybody would have had full confidence in the financial statements. But unfortunately, it really doesn't happen like that in the real world. And that is perhaps one of the reasons why financial statement analysis gets all the more importance, since you know that you are dealing in a financial statement which can probably hide more than what it reveals. Okay, so in that context, let us see a few questions before I proceed with the topic for the day. Most important question is, what are financial statements? Most of us probably would know the answer. No rocket science involved in this. Okay. So generally, when somebody says financial statements, he or she would understand it as a depiction of the company's finances. We generally know statements would include a balance sheet, statements will include financial, your profit and loss account, you have a cash flow statement, there would be a notes to accounts, a director's report, an auditor's report. All this forms part and parcel of the financial statements of a company. Now, when generally somebody says analysis of financial statements, you would analyze these statements that I just listed out. You analyze a balance sheet, you analyze a profit and loss account, you read through the notes to accounts, you read through the auditor's report, you read the director's statement. The analysis can be in different forms. You can, there are different ways of analyzing it. The most important ones and the most popular ones are the ratio analysis. Most of you would know it. They would also do a horizontal analysis. They would do a vertical analysis. So once you know what financial statement you want to analyze, you can use the various tools that is available to analyze the financial statement. Now, specific to the topic that we have, you need to understand how a bank financial statement is. And to understand that, you need to first know what is the primary function that a banking institution would do. So generally, unlike a normal trading company or a manufacturing company which is primarily engaged in the business of buying and selling goods. A banking institution's core business is not that of buying and selling goods. The primary function of a banking institution would be more so of accepting deposits, giving loans, giving advances. So this is its core business. And then they have a secondary function, which is probably forex dealing or an underwriting business, etc., etc. So when somebody speaks of a financial analysis, what is more important is you first need to know what is it that you're analyzing. It can't just be one thumb rule for analysis. You can't have a same pattern of analysis that you do for a trading company and use the same methodology for analyzing a banking institute. For that reason, that segregation of what its primary function and secondary function is all the more important. Now that you very clearly know that you're dealing with the banking company whose primary function is to deal with deposits and give loans, the pattern of analysis also would probably take the color of this particular financial function. Okay. And unlike many other institutions like a trading company or a manufacturing company, you have banking institutions which are covered under a lot of regulations. Now that also to a great extent determines how that analysis has to be done. If you take a banking company, for instance, you have a Banking Regulations Act. A lot of guidelines are given in the Banking Regulations Act as to how the financial statement of a banking company should be. You have Companies Act, which says how the drafting has to be done. You have the Information Technology Act. You have the Income Tax Act. All these act in bits and pieces will tell you how the financial statements of a banking company should be prepared and presented. So any person who is analyzing the financial statement should also, in the hindsight, keep in mind that there are some regulations which probably will tell you how this financial statement should be drawn, and your analysis should be in light of these various provisions that would be there in the Banking Regulations Act or Companies Act or the Income Tax Act. And all the more important would be the circulars and the notifications that would be issued by the Reserve Bank of India from time to time. For example, let's say the provisioning requirements. All banks should have a certain amount of provision that they need to maintain as per the provisional norms whenever they report a non-performing asset. Now, this is not the decision of the bank. There is a guideline which says that this is the quantum of provision that is required to be kept. So any person who is analyzing should also see to it that he knows a little bit of this provisioning norms, so that whenever he is making a analysis, the analysis is more meaningful, as in the outcome and his presentation of what that analysis is in tune with what the regulation also requires that particular institution to do. So this is the backdrop. So what you need to know is when you analyze a financial statement, sorry, you first need to know what is the core business of that particular institution. Specific to today's topic, when we say that we are going to discuss about analysis of a bank, what you need to understand more is the primary function of a bank is to lend and to borrow in the form of deposits. As such, most of the analysis that you do probably would be in connection with the advances or in connection with the deposits that the banking company will raise. This is a small difference that we generally find. If you see the balance sheet on the left-hand side, this is a typical balance sheet that would be drawn up for a trading company or for a manufacturing company. And if you see the balance sheet on the right-hand side, this is a typical balance sheet that you would find for a bank. If you notice the difference, a typical trading company or a manufacturing company or other than banking company, if you see a chunk of their liability would be generally reported as a share capital fund or a reserves and surplus, or for that matter, profit and loss balance. And then you have a small component in the form of a net debt. The strength of a balance sheet of this kind is generally demonstrated by a huge balance in the equity. So any company which reports a huge reserves and balance and a huge profit and loss account balance and a very less debt, generally you will say that this is a very sound financial company, because they are reporting very less debt component, and a lot of it is owners funds and a lot of it belongs to the shareholders of the company. Similarly, on the right hand side, if you look at on the left hand side, if you look at the assets, you will find that a lot of the assets would have been categorized as fixed assets and working capital. Now, quite contrary, if you see the bank balance sheet, you may find that the equity base is very small. You will find that the normal debt base is very small. A lot of it gets reported by way of deposits, as you see a green color there. A chunk of the liability side is deposits, and a very small chunk of it is the owner's fund or the shareholders' funds. Similarly, on the asset side, what you would generally call as fixed assets and working capital for a non-banking institution or for a core manufacturing institution, that gets substituted by a huge quantum of what you popularly call as advances or you call as loans. And you may have a very less of fixed assets and probably a little bit of trading assets when you look into the balance sheet of a typical banking company. That is where the analysis happens. Now, if you do analysis for a company which is on the left-hand side, probably a lot of analysis would happen or revolve around the equity. A lot of analysis would happen for the non-current assets. Typical example, return on capital employed. You would have all worked it out. Return on capital employed, return on equity, return on assets, EPS, DPS, PE ratio. Now, all this primarily would be worked out with reference to the equity part of the balance sheet. Now, the same ratios cannot be used when you work out a banking company institute. You can do it, but since the focus is on the main or the core item that is there in the financial statement, what you would have otherwise done for an equity in a non-banking institution, you would probably do the same thing for a deposit and a loan when it comes to a banking institution. That's why when we discuss further, you will notice a lot of the analytical tools that I'm going to discuss would be oriented towards deposits, would be oriented towards the loan, the advances that is there in a financial statement of a banking institution. A small example, if you look into the HDFC balance sheet, the same thing what I now explained, you look into the capital. This is as on September 2020, the latest half-yearly report that was published. The capital of HDFC Bank is just 55,037 million rupees. Now, if you look into the deposit base, it is close to about 122.93, 1039 of a total of 160.94, So if you convert it, close to about 75% of the entire liability in the balance sheet of HDFC Bank represents the deposit itself. So there is no point in analyzing the equity. That by itself will not tell you anything. So there would be probably tools which would be applied on the deposit. How you analyze the deposit, you would probably want to find out whether there are any chinks in this deposit number that has been reported. Are there any gray areas or warning signal in this deposit? So that is how you analyze it. You are more analyzing it from the viewpoint of what constitutes a significant chunk of item in your financial statements. Quite contrary, if you look at ITC's balance sheet. What I said earlier, a huge amount of deposits constituting close to 75% of the balance sheet figure. If you look into the ITC's balance sheet, you will not find that figure at all. So rather than having a deposit figure, you're talking about equity and other equity close to about 63 to 64,000 crores out of a total of close to about 75,000. So that constitutes nearly 70 to 80% of the entire liability base of ITC Limited. So just two examples to show you how a balance sheet of a banking institution would significantly differ from how a balance sheet of a non-banking financial company would look like. So where the core thrust is on equity and fixed assets, when you're looking at a non-banking financial institution, the core thrust would be more so on a deposit and an advance as far as a banking institution is concerned, which would not be the case when you're looking at non-banking financial institution. Okay, now that we know that the primary activity is deposits and advances, and that I'm telling you that lot of emphasis and analytical tools that would be used would be more so revolving around these two items. Let us see a few handful of core analytical items that would be done by a potential investor or by anybody who is analyzing the financial statements of a banking institution. The most important item that most of them look for in a financial statement of a banking institution is something called as a GNPA or gross non-performing asset. We all agreed that the core business of a banking institution is lending. Now, when you lend, there is a potential possibility that some of those items which the bank has lent to the customer is not coming back or not coming back in time. I also told you earlier that you have to read the banking institution's financial statement with reference to the regulations that is there in place. So RBI very clearly has strict guidelines, and it says that if a particular item of advance is not serviced or if the principal is not paid within a certain number of days, bank mandatorily has to treat such items as gross non-performing assets. Okay, so gross NPAs are the total of all loan assets that are classified as non-performing assets as per Reserve Bank of India guidelines. Now, what happens is when the gross non-performing assets increases in size for a particular banking institution, one of the main item that is linked to the advances is the interest income that a bank is going to get. So the whole idea of bank lending it to the potential borrowers is to get an income. The income is either in the form of interest income, or to a certain extent you get commission and other miscellaneous income that is associated with the loan transaction. Now, when a lot of this loan is not going to be serviced, bank will suffer in the form of reduced income, and which eventually may result in a loss being incurred by that particular banking institution. As such, a lot of emphasis is given on this particular performing assets, or whether it's a non-performing asset, and periodical monitoring is also being done to see to it that the percentage of gross non-performing asset in a banking institution is kept to as low as possible. Quickly, one of the guidelines that Reserve Bank of India says, if you don't pay the interest for a continuous period of 90 days. So what the Reserve Bank of India guideline very clearly says is, if a particular advance has not been serviced, that is the borrower has not paid the interest for 3 consecutive months, such advance should be treated as non-performing asset. So any institution, banking institution, financial statement you look into, you have, there would be a management analysis page, and the bank itself will calculate this NPA and give it to you. So you will have to just analyze and see either quarter on quarter or half yearly basis or on yearly basis, whether this particular percentage of gross NPA is on a increasing trend or is it on a decreasing trend. The moment it shows it is on an increasing trend, it technically is a red or a warning signal as far as a banking institution is concerned. You wouldn't want a bank to be sitting on sticky loans, which is not going to get serviced either in the form of interest or in the form of any other income or revenue generating activity for the bank. You would want that particular percentage to be on the decreasing trend. Okay. I've just given you a list of various banks, and I've also reported the GNPA and the NNPA numbers. Now, if you see, these are the top 10 private sector banks in India. As you all know, HDFC for ages has maintained a quality balance sheet, and if you see their not just the GNP and NNP ratios, if you see any of their ratios, they are the best in class as far as the Indian banking industry is concerned. That is why you know that so much of premium is associated with the stock price of HDFC Bank, even the HDFC, the other twin of a HDFC institution. So if you see their reporting and if you see their various ratios, they are either the ideal ratios or they are the best in class ratios that you would find for any institution, and all institutions would probably want to emulate or try to achieve the numbers that HDFC Bank is reporting quarter on quarter. So if you look into the GNPA numbers, it is 1.08 as far as HDFC Bank is concerned. So how you would interpret probably is, of the total advance base, 1.08% of that advance base is reported as gross non-performing asset as far as HDFC Bank is concerned. Likewise, if you look at Kotak Bank, it is reporting 2.55%. ICICI Bank is on the higher side, 5.17%. Likewise, if you look at other institutions, Federal Bank is reporting 2.84%. Now, in the last line, I've given one other institution, Lakshmi Vilas Bank, 24.45. Now, if you are analyzing the financial statement of a bank, and if you were to compare two institutions, let's say HDFC Bank and Lakshmi Vilas Bank, you would say that HDFC Bank, of the total asset base, that is the advances base, it is only saying that 1.08% of this entire asset or the advances is sticky. As far as Lakshmi Vilas Bank is concerned, 24.45% of the entire advances is sticky. Anybody's guess. You can very well say that out of every 100 rupees that HDFC Bank is lending, 1 rupee is the quantum which is not going to be serviced either in the form of interest, whereas Lakshmi Vilas Bank, out of 100 rupees, nearly 25 rupees of their advances is not going to be serviced by way of interest. Now, this 25% is easy enough for you to come to the conclusion that this particular bank definitely will report a loss, or if at all it reports a number, it is going to be a minuscule profitability number, because a lot of their advances, which is the core or the primary business of this banking institution, is an unserviceable component as far as the balance sheet of Lakshmi Vilas Bank is concerned. So when they take deposits from any depositor, they will have to pay an interest. That same deposit has been sanctioned by way of advances, but here is a case where out of that sanctioned amount, 25% of the sanctioned amount is not going to generate any income for them. So that 75% of the amount for which they would get interest, they'll have to utilize to pay towards 100% of the depositors, plus also meet their routine administration expenses and all other operating, day-to-day operating expenses and other expenses of the bank. So very clear case where you will say that HDFC Bank is very well managing the primary business. As far as Lakshmi Vilas Bank is concerned, they're struggling to manage their primary business, that of sanctioning advances and accepting deposits. Second item, net non-performing asset. Not a big difference between GNPA and NNPA. Now, GNPA generally refers to the gross. So if somebody says that of my total advances portfolio of 1,000 crore, let's say 1% or 100 crores is non-performing, that technically doesn't mean that the entire 100 crores has been written off in the books of account. The net non-performing asset is the one which will tell you how much is the actual burden on the bank. The difference between NNPA and the GNPA is the provisioning element that comes into the picture. I told earlier that Reserve Bank of India is very strict in terms of how to interpret the NPA and what has to be done if you are reporting an NPA. So that is where the provisioning now comes into the picture. So as per the Reserve Bank guidelines, it says that once you have classified a particular advances as a non-performing asset, you will have further classification as whether it is a loss asset or whether it is a substandard asset or whether it is a doubtful asset. Depending on how you classify these advances, either as substandard or loss asset or as a doubtful asset, there is a requirement for provisioning, 30%, 50%, 100%, etc., etc. Now, to the extent you have provided in the books, you know how a provision works. I am pretty sure all of you are commerce students. So whenever you say that you have provided for an X amount, that provision part of it comes in your profit and loss account. So when somebody refers to a net non-performing asset, what he or she is referring to is the gross amount. To a certain extent, you have identified what is the amount of provision that you need to provide for in relation to this particular sticky asset or a bad asset. That provision comes to your profit and loss account. And once you deduct this provision from your non-performing gross item, what you end up getting is the net non-performing asset. So the provision part is something that is going to hit your profit and loss account. That is where the GNPA and NNPA number comes into the picture. The higher the gross non-performing asset, it's a sure gone conclusion that you will end up paying more of, or rather you will park more in the provision account, and that provision will definitely take a hit on your profits that you have earned. And as a result of which, your profitability for that particular year or succeeding years will come on the lower side, because you are increasing your provision to provide for more loss assets every year by way of non-performing assets. Okay. Continuing the same example earlier, I have shown a list of 10 banks. You saw what the gross NPA figures are. Now, if you read the NNPA figures with the gross NPA figures, you can find that HDFC Bank has told you that in all 1.08 of their advances are non-performing, out of which they have provided for an X amount. What is that X amount? It is the difference between 1.08 and 0.17. So if you today analyze the financial statement of HDFC Bank, you will find that there is only 0.17% of their total advances, which they say is either not considered as performing. In other words, they have already provided for the difference between 1.08 and 0.17. That is close to about 90 basis point by way of a provision. Their profit has already taken a hit. The reserves and surplus have already accounted for the entire provision that is required to be provided as far as this quantum of GNPA is concerned. So likewise, if you see all banks, you will find the GNPA figure and the NNPA figure. Kotak, if you say it has reported 2.55% as the gross NPA, 0.64 as the NNPA, nearly 1.8% has already been provided for. Similarly, if you see ICICI Bank, GNPA is on the higher side. It may not be a good sign. It says that 5.17% of our loan portfolio is not performing, but they have already provided for close to about 4.17% of this amount as a provision. In other words, the profits of the successive years has already been accounted for this amount of provision for the quantum of bad debts or non-performing assets that is there in the ICICI Bank. Lakshmi Vilas Bank, the same example that I gave you earlier. So Lakshmi Vilas Bank says 25% of our entire advances is non-performing, out of which there is still 7% which is NNPA. In other words, they have provided for close to 16 to 17% for the various provisioning requirements as per the Reserve Bank of India guidelines. So One of the core analytical tools that would be used by the banks, the GNPA and the NNPA numbers. So any person as a student or as an analyst, when you're analyzing the financial statement, the profitability to a great extent will be linked to the core business. So the profitability in this particular case is linked to the advances. So two fundamental equations or ratios that will be used as a tool by any analyst to see how well the bank is managing their core portfolio of advances. One is a GNPA and one is NNPA number. Higher the GNPA and NNPA number, not good for a financial institution. Lower the GNPA and NNPA numbers, good for the financial institution because all their assets are performing. Very few advances are in the category of non-performing assets. Now, in addition to doing these two, GNPA and NNPA analysis, any financial statement, you will get the annual reports. What you can see is over a period of time, how have these numbers fared for this particular banking institution. Now, if you take ICICI Bank's number, financial statement, you can see that they have reported the GNPA and NNPA numbers for last 4 years. So in the year 2017, the GNPA number was 425. I think it is crores, in billions. In the year 2018, it increased from 425 billions to 540 billion. In the year 2019, it has decreased from 540 billion to 462 billion. And in the current year, it has decreased from 462 billion to 414 billion. Definitely a positive sign as far as the analysis of the financial statement is concerned. What was 425 crores in 2017? By itself has reduced to 414 crores. Even though there was a steep jump between 17 to 18 from 425 to 540 crores, they have been able to clean their books, and lot of this has subsequently been reported or has been provided for. And now, as at the end of 2020, they are reporting a gross NPA numbers of 414 billion rupees by way of a NPA. So this is another way of analyzing the statement, wherein you make a comparison, horizontal comparison or a vertical comparison over a period of time, and based on that analysis, you can come to a conclusion whether the particular balance sheet or a financial institution is handling their primary business core items well, or are there any gray areas which needs to be further analyzed for you to come to a conclusion or a better judgment. Similarly is the case with the NNPA. What was 254 billion has come down to 101, very manageable limit as far as the ICICI Bank size and scale balance sheet is concerned. So very minuscule 1.41%, what you saw here. It says 5.17 coming down to 1. So it has come down to close to 1.141% as at the end of March. It has now further come down to 1 is what I told you earlier. Okay. So another way of analyzing it over and above defining what a GNPA is and a NNPA is. Now this can be a further analysis. Okay, see how the financial statement itself will help you to make a threadbare analysis of the core item that is associated with the banking institution. Now that you have said that there is a GNPA and there is an NNPA, you probably are not in a position to effectively tell what constituted this GNPA number and a NNPA number. So you would probably be interested in knowing what was the area of stress, which are the sectors that resulted in this particular GNPA and NNPA numbers, what are the potential area where you can take a corrective, where the bank perhaps should take a corrective action. If this trend was to continue, what can be the potential problem in the near future? So a small analysis, what you will find in the annual report itself, management discussion analysis. So if you see this particular chart, we said that the gross NPA number of ICICI Bank is close to about 414 billion. They have given you a list of what are those items which has resulted in this particular 414 billion. So if you see the retail finance there, retail finance has a share of close to 20% in this total number. But what is more important is this particular figure, which was 60 billion in the year 2019, has increased from 60 billion to 83 billion. So one of the primary reasons why the NPA has increased is because the retail loan generally constitutes car loan, you have the housing loan, you have other commercial business loan. So all this, there is a footnote there which gives you an explanation of what retail loan is. So this quantum of loan that the bank has sanctioned is seeing more stress. So they are not able to effectively recover a lot of the EMIs that is connected to these particular loan category. And of late, we have also seen this problem because of COVID, a lot of home loans, we found that there was a moratorium and a sanction extension given for a lot of home loan, car loan parties that they could extend their or defer their EMI payment till August end. So that is one of the reasons that you see that there was already a stress in the retail finance portfolio of the banks, as evidenced by this number. From 60 crore it had increased to 83 crores, and now even post March we find that a lot of these banks are facing a severe pressure as far as repayment of retail finance is concerned. Likewise, the bank has given you a list. It says what are the various sectors and what was the preceding year's number and what is the current year's number. So if you see that other than the retail finance, power is one which is facing a little pressure up to 12.6%, but year on year it has seen a decrease. So likewise, if you make an analysis here, you will know what is the core area where the management feels that there is going to be a likely pressure in the near future, which potentially can affect the number of their GNPA increasing or number of their NNPA increasing. So this 3 or 4 items put together can be a very good analysis tool as far as financial statement of a banking institution is concerned. So you can probably start with GNPA. You can look into the annual report, compare 3 or 4 annual reports of various banks and see how their numbers are as far as the gross NPAs are, what their numbers are as far as NNPAs are. So when you do a cross comparison itself, you will come to a conclusion which bank has handled their portfolio better. Further, you can add on to that and see what their numbers are over the period of last 3 or 4 years, whether it's an increasing trend or whether it is a decreasing trend. You can also further add on to your analysis the list that the bank itself would provide and would probably tell you which are the areas of stress. Look into those areas of stress for you to come to a conclusion that in the near future, whether if the same trend was to continue, what impact it might probably have on your EPS, what impact it might probably have on your profitability. Just as an example, if I, let's say, retail finance, if I say is a core business for ICICI Bank, and if this trend was to continue, if every year, if the GNPA and NNPA numbers were to increase by 20%, it's a sure short conclusion that to that extent my profitability would suffer, because with the higher percentage, I'm only trying to tell that there would be a bigger or a increase in my GNPA numbers as also my NNPA numbers, because I would have to provide for more sticky advances, and that provision definitely will hit my profits in the near future. So that is a simple way of how you can analyze the GNPA and the NNPA numbers. Okay, moving forward. Another important ratio, which is again peculiar to banking institution alone, which is called as a CASA ratio. With the proper, in a normal trading company's balance sheet, nobody bothers about what is a CASA. You don't bother what money is in the current account and what money is in the SB account. But a typical banking balance sheet speaks more about what is called as a CASA. CASA popularly called as current account and a SB account balance. Now, again, going back to my first slide where I said the primary business of a banking institution is advances and deposits. On the advances side, we saw that one of the important ratio was the NPA part of it. On the deposit side, what a financial institution would be more worried about is, do they have cheaper funds with them which they can lend to the potential borrowers, or are they lending to the potential borrowers funds which they have got at a higher rate of interest? So when somebody speaks about CASA ratio, it is the ratio between the cheap funds that is there in the books vis-a-vis the costly funds that is there in the books. So typical example, fixed deposit. Generally, a bank ends up paying about 6 to 7% by way of rate of interest when you're talking about a fixed deposit. As far as current account is concerned, bank pays nothing. It's current accounts don't carry any interest rates. And SB, generally they end up paying about 2 to, some banks would pay up to around 4 to 4.5% by way of an SB interest. So what the bank would be interested is to have a major chunk by way of a current account deposit and a SB account deposit, and a lesser chunk or at least a equal proportion as far as CASA, SB deposits and other than CASA, SB deposits is concerned. So how you can use this particular ratio for an analysis is, what you do is, in a particular bank balance sheet, you try to find out what is the proportion of this CASA deposit to the total deposit. The moment you conclude that the financial institution is carrying more of CASA deposits and less of non-CASA deposits, for you it is a conclusion that the interest expenditure that the banking institution will incur will be on the lesser side as compared to any other banks which is banking more on non-CASA funds to meet their advances requirement. Okay, so CASA in simple is the ratio of current account SB deposits to the total deposits of a banking institution. And once you come to the conclusion, or once you find out what is the ratio of CASA deposits, higher the CASA ratio, the simple conclusion is more will be the rate of interest, everything else being good, more will be the lesser will be the interest income for a banking institution, which obviously would result in a higher profit as far as the financial institution's bottom line is concerned. If you take the same example again, all these banks which I listed out earlier, if you see the good quality top banks, all of them will have a higher proportion of CASA ratio. So if you look at HDFC Bank, of the total deposit base, 42% of the deposits come from current account and savings bank account. Needless to say, the remaining 58 perhaps is the fixed deposit that they get from the customers. Similarly, Kotak Bank is reporting as high as 57.1. ICICI Bank is reporting 40.3. Axis Bank is reporting 42. So all top banks, all top private banks have at least a minimum of 40 to 60 ratio as far as CASA is concerned. Now, if you look into some of the other banks, City Union Bank just has about 25%. So now if you analyze it, you will know that a lot of the funds that the bank is using for advancing are those costly funds. Let's say you are acquiring at 6% or 7%. Unless you lend it at a rate higher than 7%, you will not be able to get that spread between the two rate of interest, in which case your bottom line is definitely going to suffer. But no such problems as far as top banks like HDFC Bank and Kotak Bank and ICICI and Axis Bank is concerned. So in a nutshell, other than the NPA, CASA is something that can significantly affect the profitability of a banking institution. So when you're analyzing the statement, see what is the proportion of that CASA deposit that the financial institution is carrying. If the CASA deposits is on the higher side, no bank can get 100% CASA deposit, but a substantial amount by way of a CASA deposit to the total deposit as a percentage is always advisable and better for any financial institution to which indirectly will see to it that their bottom line is improving or reports a healthier number as compared to other institutions. Credit to deposit ratio. Again, going back to the core business, the advances and the deposits are the one which is the primary business of a banking institution. So when somebody says what is the credit to deposit ratio, what they are trying to indicate is what proportion of this amount that the bank has raised by way of deposits has effectively been utilized by them for advancing to various customers. Now, there is no fun in the banking getting the deposits and no money going by way of a loan in advance. Of late, you find the banking institutions telling that not many people are coming to borrow loans. So this is the problem that they will face. On the one side, they are getting a steady inflow of deposits because a lot of people with the stock markets not doing well, for safety's sake, a lot of people would go to the bank and park their money for 6 to 7% rate of interest. So banks would be flush with funds. They will have a lot of CASA deposits. They would have a lot of fixed deposits. But at the same time, on the other side, not many people are borrowing. So bank will have a lot of pressure on the interest expenditure, but at the same time, they're not going to get the income by way of interest. So a healthy credit to deposit ratio is something that all financial institutions would be looking at. I mentioned an ideal ratio. Generally, you say anything between 80 to 90% is ideal. So if at all it is possible for you to extend the 90% of all that money that you have raised by way of deposits, by way of an advance, that is an ideal scenario for any bank because they are not sitting on idle funds, which is going to be a cost as far as the financial institution is concerned. At the same time, a very low ratio, as I mentioned there, a very low ratio is also not an advisable option because a very low ratio would suggest that bank is not earning enough, in which case their expenses will definitely be much more than their income. At the same time, a very high ratio is also not advisable because if the bank was to lend more than what it is going to receive, any unforeseen situation tomorrow, bank would not be in a position to meet such unforeseen requirements. Okay. So if you see some top banks, HDFC Bank, very close to that ideal ratio that I was referring to. So in the year 2019, they had reported a ratio of 94%. So for every 100 rupees that they were able to get by way of deposits, close to 94 rupees they were able to lend. And there is also an adequate cushion close to about 6 rupees, which they could use for any unforeseen requirements. From 2019 of 94, it has reduced to 91 in the year 2020, marginal reduction, but still well above that average of comfort level of 80 to 90% that I had indicated earlier. Look at Axis Bank, almost the same. It was 92% in the year 2019, close to about 91% in the year 2020. So all top banks generally manage their CASA portfolio well, generally manage the credit to deposit ratio also very well, as indicated by HDFC Bank and Axis Bank. That is one of the reasons why HDFC Bank, as I told earlier, if you look into the rankings, HDFC Bank, ICICI Bank, to a certain extent Axis Bank, Kotak Mahindra Bank, they all will be in that first top 1 to 4 or 5, because on all parameters, you look at any ratios of analysis, they would all qualify and get those ideal numbers that significantly matters for any analyst or any person who is planning to invest in these particular companies, or depositors who would want to keep their money in these particular institutions. Now, look at IDFC First Bank. Prima facie, it looks like it is a good number. There is nothing wrong in that number. In the year 2019, the credit to deposit ratio was 122, and in the year 2020, the credit to deposit ratio is 131. But what you need to ask is the quantum of pressure that is there on the funds. So they are lending 122 rupees, whereas what they are able to collect is only 100 rupees. They are lending 131 rupees. What they are able to collect is only 100 rupees. So if you now say their CASA deposits is already gone, the other deposits are also is already being utilized, then they may have to borrow at a higher rate of interest to meet their advances requirement. So this is very much on the higher side, not a good scenario, because anything going wrong tomorrow, they will not be able to cushion that unforeseen circumstance with the capital which is there in their own balance sheet. So nothing is technically left in their balance sheet to meet such unforeseen circumstances. Next, net interest margin. So other than NPA that we discussed and CASA, another primary or a very important factor that most analysts look in a banking or a financial institution's balance sheet is the concept called as net interest margin. The difference between the interest earned and the difference between, the difference between the interest earned and the interest expended generally or popularly is called as net interest margin. You would always want the NIM, as it is popularly called as. The NIM should always be positive as far as any banking institution is concerned. So some factors which will affect the NIMs, as I explained earlier, high base of CASA deposits certainly will push up your NIM, because the rate of interest that you would end up paying will be on the lower side as compared to the rate of interest that you would pay on other than CASA deposits. So you find out what is the interest percentage earned, you find out what is the interest percentage expended. The difference between the two would popularly be interpreted as NIM for a financial institution. When the quarterly results are generally declared, you will see the pop-up being flashed in CNBC TV 18. This is the NIM, this is the NIM. We find a quarter-on-quarter increase in NIM, year-on-year increase in the NIM. So when NIM increases, it only speaks volume about how effectively the bank has managed its advances portfolio, how it has managed its CASA ratio, and that invariably would result in a better performance as far as NIM margin is concerned. Look at the institutions again. The spread that HDFC Bank has close to about 4.3. So the interest earned on its loan portfolio as reduced by the interest that the bank has spent on its various deposit portfolio has resulted in a net excess of 4.3. And this net excess is something that the bank would then utilize for the purpose of meeting its administration expenses and reporting a profit, which then gets distributed by way of dividend and plowed back in its reserves and surplus. So higher the percentage, better the performance of the bank. Again, if you see the top banks, Kotak Bank has reported 4.4. Bandhan Bank, of late you hear a lot about Bandhan Bank doing well on all parameters. So this is one example. It is reporting as high as 8 percentage when it comes to NIM. Go to Lakshmi Vilas Bank, what I reported earlier, very poor performance as far as, not that I have anything against Lakshmi Vilas Bank. These are numbers and it speaks by itself. Very poor number as far as CASA is concerned. GNPA and NPA numbers not doing very well. And that can also be seen in the NIM. Since the bank has not been able to well manage their advances portfolio because they were reporting more of bad debts, they were forced to provide more by way of provision. Okay, and add to that, they were not able to get a lot of interest margin, and 1.37 therefore would not have been sufficient to provide for all those provisions and meet their expenses. Needless to say, the company, the bank has reported a loss as far as the reporting year, subsequent reporting year, preceding reporting year is concerned. So this is one critical factor that decides how effectively the bank functions, exhibited by way of something called as net interest margin or NIM. So all top banks you see here have done well as far as NIM is concerned. This again is the statutory report of ICICI Bank. You can see how they worked out their NIM numbers, and they've also mentioned something about interest spread. Okay, this, if you look into the financial statements of the banking institutions, you can also look at that bottom line. What is the interest spread? Higher the interest spread is another analytical tool for you to come to a conclusion that bank is very well managing their advances portfolio and their deposits portfolio. The cost that the bank incurs is far lower than the revenue that the bank is generating, as explained by NIM margin, as also the interest spread margin. So if you look here, year on year, if you were to compare, the net interest margin, which was 3.42% in the year 2019 for ICICI Bank, has improved, and it is not a small number, has significantly improved to 3.73. So if you look into it, close to about 0.3 basis points as far as the increase is concerned. And the interest spread also has increased from 2.93% to as high as 3.29%. And that effect, immediately you can see the net effect of this on the stock price. See how on that particular day, if you see the movement of stock, as soon as these results are declared, you'll find a quantum jump or a percentage increase in the stock price, for simple reason that these numbers by itself would suggest that if this trend were to continue, the bank is only going to report much healthier number in the near future, and stock price is nothing more than a reflection of the EPS and the profitability number of the institutions or the banks, as the case may be. So this definitely is one yardstick for you to come to a conclusion that whether the bank is doing well or bank has performed not so good as far as that particular year's financial statement is concerned. So we have looked into how GNPA can be used, the deposit ratios can be used, the credit deposit ratios can be used, how NIM itself can be used for you to analyze the financial statement and come to a conclusion whether the bank is doing well in terms of its profitability or not so well in terms of its profitability. So these are some key tools that is generally used by analysts for analyzing the performance. To a certain extent, yes, you have return on assets. That is all the assets, to what extent it has generated a return. So as a analysis tool, you can definitely use this. Higher the ratio, improving ratio is always good, which would suggest that bank productively is utilizing their assets for generating more return for their shareholders and for the stakeholders. So if you look at ROA again, some top banks 2.14, 1.98, 4.21 Bandhan Bank, and same case Lakshmi Vilas Bank minus 1.65, to indicate that since they are reporting a loss every year, the assets are not being productively used, but it is being unproductively used. That's some conclusion that you can derive. Rather than utilize the assets to generate profits and report a healthy ROA, here is a bank which utilizes the assets, further erodes the value of their shareholders by reporting a loss, which is nothing more than unproductively utilizing the assets, is how you can conclude as far as Lakshmi Vilas Bank's number is concerned. Another important one, capital adequacy, is a measurement of bank's available capital expressed as a percentage of bank's risk weight capital. So when somebody says how strong is a bank, the base capital base is the one which is something that you would be looking into, because when the bank has to lend, it needs to have adequate capital in its balance sheet for it to lend. So one ratio, which is also a regulatory requirement, RBI has got several guidelines as far as capital adequacy requirement of the bank is concerned. So higher this number that a particular bank is maintaining in its book, more healthier the financial statement is, how an analysis can be done. So if you look into the last line, generally there is a concept called as Tier 1 capital and Tier 2 capital in a bank, which is used for identifying this particular ratio. So you add up the Tier 1 capital and the Tier 2 capital. There is a small definition for tier 1. Equity capital generally comes under Tier 1. Most of you know what equity capital is. So all audited part of the financial statement, all those constitutes your Tier 1 capital. The unaudited component becomes part of your Tier 2 capital. Imagine today if somebody looks into the balance sheet, anything that has happened post September, if you say that it is unaudited part of it, but it still constitutes a reserve, you can add that and then you say this is my capital divided by the risk-weighted credit exposures. So you have 100 rupees of capital, you have a total credit exposure of 1000 rupees. So you say 10% is the capital that the company has. Why do you require this capital? Again, same. For any unforeseen circumstances tomorrow, you see whether the bank is in a position to cushion that requirement. If you have a substantial ratio in the form of capital adequacy ratio, sufficient ground for you to come to a conclusion that any unforeseen circumstance, sufficient capital is available with the particular bank for it to meet the contingencies or the requirements. This is where generally the private banks are better as compared to public sector banks, because public sector banks use of late here the government of India providing for more capital to such public sector banks. That is nothing but for them to increase their capital adequacy ratio. So if you look into the guidelines, there is a Basel norm which says that there should be at least 8% of capital to risk weighted assets and at least 10.5% under Basel III norms. So if you take this as an ideal ratio and compare it with what actually the banks have, you can see HDFC Bank has close to about 18.9% as the capital adequacy ratio. So what you're trying to tell is for every 100 rupees of its risk-weighted credit portfolio, it has close to about 18.9 rupees in the form of Tier 1 capital and Tier 2 capital. So any eventual requirement tomorrow, bank adequately has or adequately is capitalized for the purpose of meeting such unforeseen requirements. So you see as high as 21 for Kotak Bank, as high as 26.5% for Bandhan Bank. So all these are top good quality banks which are reporting a very healthy capital adequacy ratio to suggest that any requirement tomorrow, they are in a position to internally provide or fund those requirements from the capital base that they have. Quite contrary, the last line again, Lakshmi Vilas Bank, which is reporting a negative capital adequacy ratio of 2.85. In other words, they would have probably utilized their entire capital, and now they are also eating into some other sources of funds that is there as part of their financial statement. Definitely not a good sign as far as the health of this particular balance sheet or financial statements of the banking institution is concerned. Okay. As I told you earlier, it's provision coverage ratio. You can read it along with the non-performing ratios. If you separately calculate it, it only goes to show what proportion of that GNPA number has already been provided for by this particular institution. Higher the number is always better, because it indicates that a lot of this bad loan has already been provided for in the books of accounts, and the profit has already taken a hit to this extent. So at least in the near future, there is nothing much that the company or the bank needs to provide in their financial statements to meet this requirement of provision for all those advances which are classified as non-performing. So again here, if you look into the top banks, all banks are close to near normal, 70, 75%, 80% as far as provisioning is concerned. And all the more, why? Because Reserve Bank is very strict as far as this particular provision is concerned. So they would be monitoring it on a higher level to see whether all these requirements have been met. So if you see the banks, most of those banks have already crossed 70, 65, 70%. So tomorrow there won't be a nasty surprise by any institution which may suddenly say that I have not provided for any of this loss in the past. So most of those banks have already provided for it. So any recovery happening on a subsequent day, it is only an income for the bank, since they've already knocked off the entire item from their books of account by way of providing for a provision. Okay. So this is as far as the provision ratio is concerned. Specific to this particular year, this would be an added observation for most of us. Post-COVID, what happened is most of those banks felt that there would be a stop in the inflows towards the EMIs, and government also came out with the stipulation that there would be a stop on recovering EMIs till August. That due date has already ended in the month of August, and most banks gave this benefit of extending the EMI facility to a lot of the advances portfolio. But as a percentage, if somebody was to observe, HDFC banks close to about 9% of those people, 9% of those portfolio came under the moratorium, as high as 17% as far as ICICI Bank is concerned. Now, what would be interesting here is, since that moratorium period has already lapsed in the month of August, now post September, October, November, December, what would be interesting to observe is whether that EMI has started to come, or whether there is a further stress on this particular portfolio in the banking balance sheet. When we saw ICICI Bank balance sheet earlier, we saw that the retail part of their portfolio is under stress. Now imagine if that logic was to be extended to this particular moratorium percentage, what probably ICICI Bank would now tell is, we already found that our retail portfolio was under stress. There was a moratorium that was granted up to the month of August. I mentioned initially that for 3 months, if you don't continuously service your your loan, then it turns into a non-performing asset. So if you take September, October, November, probably when the next quarter results come, that is in the month of January for this particular quarter, October to December, you might find a lot of these advances being reported as a fresh non-performing asset, and that goes by this particular ratio that you're now seeing on the slide. So already the banks have told that a lot of people have opted for moratorium. Now the next interesting question that would be there is whether these people who have opted for moratorium, will they continue to service their EMI now, or would it be an extended case where they also default in the payment of their EMIs post the lapse of the moratorium period, in which case in the near future an interesting observation and analysis will be that these banks which are now telling that a lot of their advances were under moratorium may end up reporting more of NPA, in which case all that we have discussed so far will become a critical item for your analysis of financial statement. Needless to say, your NIMs will come down since a lot of interest has not been earned. Your GNP and NNPA numbers will shoot up because there is a lot of stress asset that is there in your books by way of wholesale or retail or corporate books that most of these private banks are into. Okay. Another small ratio, cost to income ratio, which is as a proportion to the operating income. What is your operating cost? Does not tell you anything much, but probably can tell you how bank is effectively managing its operating cost. So as an example, if you say HDFC Bank, for their operating income, they are reporting a total operating cost of 35. Definitely a good management where they say that only 35 rupees is spent by them towards their various operational expenses as compared to 100 rupees of their operational income. Very high, 68.7 as far as IDFC Bank is concerned. So a chunk of what they earn goes by way of servicing their operating costs. So very less would then probably remain to meet the requirements of dividend and anything that you would pay to your stakeholders and shareholders. So another ratio which you can analyze to come to a conclusion how well the bank has performed. Okay, so far what we have discussed is primarily from the viewpoint of one of the analytical tool, ratios, which is definitely one popular way of analyzing it. But as you have seen here, these ratios are not like those common ratios that you would have generally worked out for any other financial institution. We would generally work out current ratios, quick ratios, turnover ratios. Now, if in the last 1 hour that I discussed, I have not made any reference to any of these ratios. That itself will tell you that a bank balance sheet cannot be generally analyzed from the other set of ratios that are usually used for trading balance sheets or manufacturing and service balance sheets. This is a quite distinct and a different set of financial ratios and other liquidity ratios that we would be using for the purpose of analyzing the financial statements. Now, if you recollect again, I said about regulatory requirement. Other than the Reserve Bank of India's stipulation, circulars, notifications, you would have heard of accounting standards. Of late, you also hear about Ind AS, you would have heard about IFRS, etc., etc. Now, these also stipulate that a particular bank's financial statement should report certain things, which also can be a good analysis tool as far as financial statement is concerned. Now, most of you would have heard about Accounting Standard 17, which relates to segment reporting, Accounting Standard 19, 18, which relates to related party disclosures. If you read the financial statements threadbare, you will come to know there is a portion where the banks will mention about frauds, whether auditor has reported any fraud, whether company secretary has brought to their notice any fraud. Now, these things you can come to know only when you read the financial statement. So as a part of your analysis, you don't just confine yourself to the balance sheet and profit and loss account and cash flow statements. You can also look into the proper notes to accounts and what the reporting is as far as compliance with accounting standard is concerned, which by itself can highlight a lot of things which may not be known to you when you peruse your balance sheet, profit and loss account and cash flow statements. Okay, so couple of them which I thought is important. Now, before I go to the standards as such, of late there is a lot of discussion about using Ind AS. Now, one of the problem with accounting standards and why do you have an accounting standards is, see, if there are no common standards applicable, each person will prepare the balance sheet in his own way. Now, there would be a very it would be virtually impossible for somebody to make a meaningful comparison of two financial statements unless he or she very clearly knows that a set standard has been used and this standard asks you to uniformly present your accounts. So that is the whole idea of having a accounting standard. So if you take inventory very clearly, the accounting standard very clearly says inventory has to be valued at. If you take depreciation standard, it very clearly says depreciation can be returned on value or straight line. Similarly, fixed asset can be shown at cost or historical value, or that's how it goes. So every standard, when you strictly follow, any person who analyzes the statement will very clearly know that since you have followed the standard, you can make a line by line comparison. Now with IFRS, what happened is IFRS is a different set of standards, and our accounting standards were not very much aligned with what the requirement of IFRS was. So to ensure that IFRS requirements are also aligned, a new set of accounting standards, popularly called as NPAs, was rolled out. It was supposed to be applicable to all the banks, but for some reason, either the banks were not prepared or for any other reason, they have postponed the implementation of this particular accounting standard. So as of now, the Reserve Bank of India has, in the month of March 2019, postponed this for a further period, and the proposed date is yet to be notified by Reserve Bank of India. So we are still using the old accounting standards, wherein the popular ones, as I told you earlier, you can take accounting standard 17. All financial statement, bank financial statement will report this. There you will get more answers to where or which part of the segment the particular bank has done well or the particular bank has not done so well. So if you now look into Lakshmi Vilas Bank, and if you look into their accounting standard 17, which I discussed, now a lot of those numbers that you saw earlier were all in the red. Bank did not do well, bank has reported a loss, the GNPA numbers were not good. So if you now look into the segment report, you would know that the primary function or the core business that the bank does is generally divided into 3 or 4 parts. You have a treasury operation generally for a bank, and then you have this corporate wholesale lending for a bank. You have a separate retail lending for a bank. Now, if you look closely into this particular accounting standard 17 report that is prepared by Lakshmi Vilas Bank, the first part, it says treasury operations. Now, if you make a comparison, in September 2019, the treasury operation was 16,000 lakh, which has come down to 11,000 lakh. So the interpretation or the easier conclusion for any person is on the treasury operation itself, Lakshmi Vilas Bank has not done well. Now the core idea of treasury operation is to well manage your funds. So if you ask what has happened here, Lakshmi Vilas Bank has not done that operation very well. Needless to say, they have not reported a good healthy number as far as treasury operation is concerned. Similar is the case with the wholesale and the retail lending. It has come down drastically from 14 to 11,000, from as high as 35,000 to 26,000. Now, if you know that their core business is lending, and if you know that in any of these part, which is treasury operations, which is retail banking operations, which is wholesale banking operations, they have not done well, you can easily come to the conclusion that the profitability will not be good, none of the ratios will be good, because on each element, line by line, if you read, no part of the banking operations were effectively done by Lakshmi Vilas Bank. Contrary to this, if you look at HDFC Bank, if you see their treasury operations, from 627,540, it has increased to 809,877. A sizable increase from 819 to 20. Even a Q on Q basis, from 800, it has gone up to 809. Now you know why all of those ratios that we discussed earlier were on the higher side, because treasury fantastically handled by HDFC Bank. Look at retail banking from 27 to 2768. Even though there is a lot of problems associated with COVID, this particular bank has done well even during those times, have managed their retail banking operations well, except on the wholesale banking side, where from 1502 it has come down to 1391. Probably to a large extent, the performance did not improve further because they were not able to do a lot better on the wholesale banking. Okay. Now you go back, you look at only the balance sheet and the P&L. No part of this information would have been there in the P&L account. You would have just probably read income from operations. Now I would be curious to know, as an analyst, what resulted in this improvement in the operations, what resulted in not so good operations. You will find the answer in this accounting standard 17, that is segment report, which I am pretty sure not many of us would do it. But as an analyst, if you do this, you will get a lot of answers here. You make a same horizontal comparison, year on year comparison, quarter on quarter comparison. It will give you many more answers, which probably can help you to better analyze the financial statement of a bank. Likewise, if you see the breakup there, you have a revenue breakup, you have a result breakup, you have a segment asset breakup, you have a segment liability breakup. Each of them can be interpreted in its own way, and you can get different answers, which can make your analysis so much more elaborate to get a better answer as to whether there is enough scope for this particular bank to improve, or does that numbers signal anything by way of a warning sign, which in the long run probably might bring down the performance of a bank. So one standard that you can use. Couple of more: related party disclosure. Again, way back, Reserve Bank of India had a reservation. The reservation is Reserve Bank said not many banks follow the accounting standards very strictly. And in particular, they pointed out that segment reporting and related party were two transactions, were two standards which were not being followed by most of those banks. Now, what this related party transaction schedule will do is, if at all there is, see, of late you would have heard a lot of these loans being sanctioned to the relatives of the managing directors, chairmen, CEOs, MDs. Now, a plain reading of the balance sheet will never make you will not you will not be able to know if at all any such transaction has taken place in the financial statements. Okay, and more often than not, what might happen is tomorrow the very same loan might turn into a non-performing asset, and that probably might constitute a sizable chunk of the entire advances portfolio of the organization. So, what this particular standard will do is, if at all in a particular banking institution there are related parties, it will very clearly list out who are these related parties. So again, as an example, ICICI Bank, if you see, so these are the key management personnel and who are the related party of the key management personnel. Number 5, if you see there, I am not casting any allegation on any person here, and this case is, I think, still in the court. But as just as an example, if you see Chanda Kochar, the related party given there is Deepak Kochar, Arjun Kochar, Aarti, Mahesh Advani, etc., etc. We all are aware of this particular case where a substantial amount was given by ICICI Bank to the Videocon enterprise, and that whole saga, that entire story, most of us know. And subsequently, the entire 3,250 crores, which was the size of the loan that was sanctioned to Videocon, was reported as NPA. If you see the last line there, in the year 2017. So, because the size of that balance sheet of ICICI Bank is so huge, this particular amount of 3,250 may not have been a substantial amount, but needless to say, big amount entirely reported as NPA. Who are the parties involved? The key management personnel, so relatives are the ones who are involved. Was this disclosed in the balance sheet? If threadbare analysis were done, most of us would come to a conclusion or would have known that there was a transaction between the key management personnel and the related parties to this particular key management person. A thorough analyst would have done his job, and if at all he found any signals, he would have been the first to know that there was a sticky loan, there was a potential possibility of some amount of the loans going bad, which would have probably hit their NIMs and their profitability. So these two standards can be extensively used by most of us. The segment reporting standard to better understand what is it which drives the profitability of the organization, where are the assets deployed, are they being productively deployed, what are the segment results, which segment of the organization is doing well. All these answers you will get in the accounting standard 17, which is a regulatory requirement. As per the accounting standards, you have to mandatorily disclose it. Similar is the case with related party disclosures, where you can see who are the related parties. Are there any significant transactions that take place between the related parties? If yes, is it something that is likely to materially affect subsequent disclosures? Will always be made. If there is a related party transaction, every quarter they will disclose it. And if there is any trigger, that also will be disclosed. But as an analyst, it is easier for me to analyze that part of the transaction and see what effect it might have on the financial statement. So these two standards can be used for further analysis. Along with this, the fraud section, because fraud as such is not evident on the face of the balance sheet and the financial statement. So somebody has to tell that there is a fraud, there is no fraud. You should know whether there was a fraud. How will you know? Please go through the annual report. There would be a reporting by the management, and this particular reporting where they would say that there were no instances of fraud reported by the statutory auditor, branch auditor. See, most of the frauds will be highlighted by the auditors. So if at all the auditor has highlighted a fraud, what is its impact? All those things has to be analyzed. So you see for a paragraph which comments about this fraud in the financial statement. As it is, management will also give a list of frauds. Now, if you see ICICI Bank, you see here, the amount of fraud that was involved was 94,728 million as compared to 23,000 million a year ago. So any person who is analyzing this will first ask the question, how did the fraud of 70,000 crores affect the financial statement? And if you also see the provision made, hardly 10,000 million has been provided for. Now, what if another 84,000 million was to come into the financial statement by way of a provision? To that extent, my profit can come down. So he will make a further study of what these frauds are with whatever available information is, what is the potential of the entire fraud getting converted into a loss asset for the organization, and when will the provision be made? If this provision comes, what impact it might have on my EPS? So these questions can be further analyzed as far as the analysis of the statement is concerned. So some standards which can be effectively used for the analysis. There are many standards. I have just picked up 3 or 4 standards. Couple of more. EPS, not very important. Doesn't really say anything much, except for that word diluted. So any person who can really analyze it, you can just quickly look into what is the basic EPS and diluted EPS. The diluted EPS is if tomorrow there are any convertible options in the balance sheet, like preferential shares, which can be converted into equity shares, to what extent the EPS of the equity shareholders might get affected is depicted by this diluted earnings per share. So you can, if you compare your 12.28 and 12.08, so if at all those convertible options get converted into equity shares tomorrow, as an equity shareholder, I can probably take a hit of 0.2 is what this particular DPS tries to tell me. So since the shareholding share price is a function of the EPS and the PE ratio, any small decrease in the earnings per share is likely to affect my share price. So when you say that there is a dilutive option in the financial statements, you can easily come to the conclusion that to that extent there might be a fall in the price of the shares because there is going to be an increase in the number of equity shares in this particular bank's balance sheet. Okay. So these are some standards. So I have not made it very elaborate. I have just highlighted some core ratios that is usually used for analyzing a bank's financial statement, and a few standards which can definitely substitute along with the ratios. If we can also use the standard, I think your analysis will be that much more meaningful, and you will be able to get better answers than what you will generally get by only looking at the balance sheet, profit and loss account and the cash flow statements. Any questions? I am Kevin?
They can type the questions. Okay. Just tell the word. No problem.
I think you can type the questions.
One person has raised the hand. Yeah. Such a question.
Is there any new amendments for COVID and post-COVID in banking sector? See, amendments, there is nothing called as amendments. In what context? I did not get the context. Are you asking me in terms of provisioning or anything like that? Then that's what. In August, that extension that was granted has ended already. So now we are back to the old regime where everybody pays the EMI. You don't pay your EMI for 3 months, it gets converted into a non-performing asset. So this is something that is already there. Other than that, specifically, there is nothing for COVID and post-COVID. How you read the balance sheet today changes, and that is why I brought that one slide in between where I said you can, at least for only for this particular year, we know that since a lot of banking balance sheets might be stressed, uh, you may have to also analyze it in slightly different form. So what we can now do is we can use that moratorium numbers that was given by the bank and extrapolate it and see what happens 3 months down the lane, because a lot of the effect of that COVID period will be known only maybe in the month of January when the next quarter results are going to be declared. So if at all the bank has not been able to recover a lot of their loans, it will happen now in the month of September, October, November. The net effect of that will be known only in the month of January. Beyond that, I don't think there is any other amendment as such.
So one person had raised the hand.
Somebody raised the hand. can unmute you can also unmute and ask questions if you want. That's it.